Let's welcome in a global voice, Daniel Morris of BNP Paribas Asset Management on the show to talk about that. Daniel, good having you. Thanks much for taking the time out. 25 basis points, a foregone conclusion, I reckon. Do you reckon the commentary might be indicative of a prolonged pause post that?
Well, I think that's what they would like to do. I think they would like to say this is the end of this mid-cycle adjustment, these insurance cuts, and that should be enough. I think really, though, the market doesn't quite believe that. If you look at Fed funds futures, the market's still pricing in more cuts this year and more cuts next year. So that tension continues between market expectations and the Fed's own desires. And we'll really be looking very closely at the commentary to see whether or not, in the end, the Fed is actually going to capitulate to the market.
Obviously, in terms of consensus, it looks like they will be looking at another third rate cut this time around. But then the next consensus for a rate cut comes straight in February 2020. Is that something that you're aligning with? And does this go back to the playbook of the 1990s where the Fed in short bursts tried to spur the economic growth through cutting rates, I think in 1995 once and then in 1998 once, where there were consecutive rate cuts? Do you think they're playing by this book?
Well, I think that's a real challenge, trying to look at any history to understand what's going on today, because clearly, we're still, frankly, dealing with the consequences of the global financial crisis. We have quantitative easing as a measure that was taken this time that wasn't taken in the past. We can also think about how inflation is structurally quite different today because of technology in the past. So all of this says that any episodes that we can look to see how the Fed reacted to the data and try to apply that today is probably problematic. I think the real question is going to be, if the Fed does cut again, what's the justification? If it's because we see further slowdowns in growth, and of course we'll get US GDP this week, then that's going to be quite challenging for equities and for risk assets in general. Up to now, you can argue it's just been insurance. It's been because inflation expectations have fallen, and that's been more supportive for risk assets. The real question is whether or not that dynamic can continue.
So, going by consensus, I believe the probability is really high for a rate cut this time. But post that, for the rest of the year, it's almost like a coin toss, whether or not they go ahead and cut rates further or no. What's your own consensus for the rest of the year as to, how much further could the Fed cut?
Well, we do expect them to cut now and then try to hold through the end of the year, though we think in the end they will be obliged to cut next year. We think growth isn't necessarily going to recover to the level that they're going to be happy with, as much because we don't expect a reversal of the tariffs that have put into place by Trump on Chinese imports and vice versa. So that's going to continue to be a drag on growth. Of course, we have all the worries centered around Europe. So without an upswing, not only in the US, but globally, we think the Fed's going to conclude it needs to cut rates further in order to support growth.
Daniel, if one were to look at the data points coming from the U.S. market, especially after the September month meeting, be it retail sales, manufacturing, all have been declining. And we'll be getting the September quarter GDP growth rate as well. What's the estimate there? What sort of growth rates are you expecting from the third quarter?
Well, consensus is just 1.6, which is quite low. It's below potential for the U.S., which we estimate is probably around 1.9%. And that's already a bigger deceleration than people thought was going to take place 3 or 6 months ago. So on one hand, we knew the U.S. economy was going to slow. Don't forget, at this time last year, the growth rate was 3.5%. So it was always inevitable that it would grow more slowly, closer to, say, 2%. But the fact that we're so far below 2% is a concern. Clearly, the direction is not the one that you would like, and the risk is that it accelerates or at least continues unless we see a catalyst to turn it around. So quite low expectations for the data we're going to get this quarter. You mentioned retail sales. Clearly, the consumer is what really everything hinges on here. Up to now, we know we've had some weakness in business investment and business sentiment, but consumers still quite optimistic. So as long as that stays in place, the Fed will probably be relatively calm. But if we see any further signs of weakness, either in sentiment or in retail sales, I think that's going to be the trigger.
Just one last question, Daniel. Let's say if the rate cut comes about what the street is expecting. Historically, whenever US goes into election year, Fed doesn't like to move the interest rates. Do you think then after this rate cut, if it comes about, it'll be a pause till the US elections?
Again, I think that's what it would like to do. It's just whether or not they're going to be able to. On the other hand, you would think about with the election coming up, that also should be a bit of support for the economy. You're going to have a lot of spending, certainly on advertising, social media, and so on. Trump, you imagine, will do what he can to support the economy. So we should see at least some short-term drivers over the next year ahead of the U.S. election. And maybe that will be enough to allow the Fed to stay on hold. But as I'm sure they're going to say, everything is going to be data dependent.
All right, Daniel, we leave it at that. Thank you very much for joining us this afternoon. Appreciate you taking out the time.